All right, so today we're going to be taking a deep dive into the CFPB.
The CFPB.
Yeah, the Consumer Financial Protection Bureau, and its role in real estate.
Okay.
And we're going to be looking at some excerpts from this study called Consumer Financial Protection Bureau, CFPB, Impact on the Real Estate Industry.
Right.
So, the CFPB is kind of supposed to be this this protector of consumers.
Right.
But some people argue that maybe they're kind of making things harder.
Yeah, it's a very, kind of a complex situation. I mean, the CFPB came out of the 2008 financial crisis.
Right.
And their goal is to prevent the type of predatory lending practices that led to that meltdown. And they're tasked with making sure that all financial products and services, including mortgages, are, fair and transparent.
So they're the good guys, right?
They should be.
They're trying to protect us from, the bad deals
Yeah.
and all that stuff. So where's the friction then?
Well,
what's the problem here?
Yeah, so this source material lays out 7 key points.
Okay.
Where things get a little sticky.
All right.
And the first one is tree.
Tree.
Heater.
Yeah.
Telarespa integrated disclosure.
Oh, wow.
Sounds like something out of Star Wars.
Yeah.
But it's really all about mortgage paperwork.
Okay, so it's not lightsaber.
No lightsabers.
Oh, okay.
But the idea behind Trade was to make mortgage disclosures, all those documents you sign at closing, much clearer and easier to understand for borrowers.
Yeah.
I mean, who wouldn't want more transparency in such a big financial transaction?
Right. I mean, less, legal mumbo-jumbo, more plain English.
Exactly.
So that sounds pretty straightforward. So where do things go wrong?
Well, Tree ID introduced very specific timing requirements and a whole lot more paperwork.
Oh, no.
Which critics say has actually led to longer closing times.
Really?
And increased potential for delays.
Oh, man.
So imagine you found your dream home, you're super excited to move in.
Yeah.
And then suddenly there's some small paperwork hiccup. And it throws everything off track.
That's the worst.
That's a huge bummer.
Yeah. So good intention, right? Like transparency.
Transparency is good.
But it's like more hoops to jump through.
More hoops, more delays.
Yeah. And that's not just an inconvenience, right?
No, it's not just an inconvenience. It affects everyone.
Right.
Buyers, sellers, real estate professionals.
Yeah.
And time is money, right?
Literally.
So more paperwork, more hours spent ensuring compliance. It all adds cost to the process.
So 2RID is kind of like a double-edged sword, I guess, trying to protect us, but then also making things kind of more complex and more expensive.
It could be a bit of a balancing act.
Yeah. All right. Well, let's move on to the next point then.
Okay.
Stricter mortgage rules.
Okay.
So this seems pretty self-explanatory, but what's the issue here?
Well, in an effort to prevent another housing crisis, the CFPB implemented things like the ability to repay and qualified mortgage standards.
Yeah.
So these rules are designed to ensure that lenders are only giving loans to people who can afford them.
Right. We don't want people, getting in over their heads.
Absolutely.
Okay.
Sounds responsible.
Yeah.
But this study argues that these stricter rules, while well-intentioned, could actually make it harder for certain types of borrowers to qualify.
Really?
Even if they're financially responsible.
So it's not as simple as, good credit and steady job anymore.
Not necessarily. Think about self-employed people,
right,
retirees, or people with income from, non-traditional sources.
Yeah.
They might have no problem affording a mortgage.
Right.
But they might not fit the very specific criteria that the CFPB uses to assess borrowers.
So it's like trying to fit into a box that doesn't quite fit your shape.
Exactly.
But you can still, pay your mortgage.
Exactly.
Okay. And this isn't just about like individual borrowers though.
Right. This has a much wider impact. It could be limiting access to home ownership for certain groups of people.
Right.
And it could even be stifling innovation in the lending market.
How so?
Well, if lenders are hesitant to offer loans that don't fit the CFPB's mold, they're less likely to come up with new types of mortgages that could actually benefit consumers.
Interesting. Okay. So stricter mortgage rules, another one of those, well-intentioned, but maybe unintended consequences.
You got it.
All right, let's move on to the third point then.
Okay.
Overreach into real estate practices. Sounds a little ominous.
Yeah.
What's the CFPB doing, getting involved in, the day-to-day of real estate transactions.
Well, it all comes down to a law called REIS-PA,
REIS-PA.
the Real Estate Settlement Procedures Act.
Oh, okay.
And the CFPB is tasked with enforcing REIS-PA,
Okay.
which is meant to prevent shady dealings and kickbacks during the settlement process.
So like cracking down on corruption, making sure everyone's playing by the rules.
Exactly.
That sounds like a good thing.
It is a good thing.
Okay.
But the study highlights that the CFPB's enforcement of REIS-PA has actually created some uncertainty and fear in the industry.
Really?
Yeah, real estate agents, lenders, title companies, they're all kind of on edge, worried about accidentally violating the rules.
Even if they're trying to do the right thing.
Even if they're trying to do the right thing.
So it's like a climate of paranoia, even if everyone has good intentions.
It can feel that way sometimes.
Okay, but what does RIS-PA actually, like, cover?
So REIS-PA is all about making sure that fees and services related to closing a real estate deal are disclosed properly.
Okay.
And that no one is getting illegal kickbacks for referrals.
Okay.
So, for example, if a real estate agent gets a fee for referring a client to a specific lender,
Right.
that could be a violation of REIS-PA.
Oh, okay. So it's about preventing conflicts of interest.
Yeah.
And making sure everyone's acting in the best interests of the buyer and the seller.
Exactly.
Okay.
But the study suggests that the way the CFPB is enforcing REIS-PA has cast a wide net,
Right.
creating a chilling effect on perfectly legitimate business practices.
So instead of just targeting the bad actors,
Right.
it's making everyone anxious.
A little bit, yeah.
And that anxiety probably leads to, you know,
More costs.
more costs.
Yeah, this increased scrutiny means everyone has to be extra cautious,
Right.
which often means hiring lawyers and compliance experts
Yeah.
to make sure they're not breaking any rules.
And those costs ultimately get passed down to
The consumer.
the consumer.
Yeah, so it's a domino effect.
Right.
This fear of running afoul of REIS-PA can lead to higher fees for buyers and sellers.
So another example of a well-intentioned regulation may be having some unintended consequences.
Exactly.
Okay, so we've covered 3 out of the 7 points.
We have?
Tier ID,
Yeah.
stricter mortgage rules,
Yeah.
and our REIS-PA enforcement.
Yes.
Let's take a look at how these regulations might impact people facing financial hardship
Okay.
in the next part of our deep dive.
Sounds good.
Okay, so we've been talking about how, these regulations, right?
That are meant to protect consumers can sometimes
Yeah.
have this kind of ripple effect, and create these unexpected hurdles
Yeah,
in the real estate process.
it's a complex landscape.
Yeah. So let's keep digging into this source material.
Okay.
And it brings us to mortgage servicing regulations.
Mortgage servicing.
What exactly does that even mean?
It's one of those terms that I think a lot of people aren't really familiar with, but
Yeah.
it's important.
Okay.
So basically, after you get a mortgage,
Mm-hmm.
there's a company.
Right.
Sometimes it's the original lender, sometimes it's a different one
Okay.
that handles all the day-to-day management of your loan.
Okay.
So they collect the payments,
Yeah.
they manage the escrow accounts,
Mhm.
they handle things like late payments or if you need a loan modification.
So it's like the behind-the-scenes
Yeah,
stuff?
and it's all this stuff that happens after you've signed all the paperwork.
Gotcha. Okay. So how does the CFPB play a role in this
Well, the CFPB has a bunch of regulations in place. Okay.
to make sure those mortgage servicers
Right.
are treating borrowers fairly
Okay.
and not doing anything shady?
Right.
Like they can't tack on all these crazy fees or mislead borrowers about their options
Okay.
or make it really hard for someone who's struggling to make their payments to get help.
So it sounds like these regulations are meant to protect people.
Yes.
Especially those, who might be in a tough spot financially.
Absolutely vulnerable borrowers.
So where's the potential downside then?
Well, our source material is suggesting that these rules,
Mm-hmm.
while they're, coming from a good place,
Right.
might actually make lenders less likely to offer flexible solutions
Okay.
to borrowers who are having trouble.
So there's like that, that fear of noncompliance we were talking about.
Exactly. Everyone's kind of walking on eggshells.
Right.
Afraid of making a mistake.
Afraid of breaking a rule they don't even know about.
Yeah. So instead of sitting down with a borrower and figuring out a solution that works for their specific situation,
Right.
lenders are more likely to just say,
Oh, okay.
here's the standard process. This is what everyone gets.
Even if it's not the best option for that homeowner?
Right. It becomes a one-size-fits-all approach.
That sounds pretty frustrating.
It can be.
Especially if you're already, stressed out about money.
Absolutely.
It's like the system that's meant to help you is actually making things harder.
It highlights this kind of core tension,
Yeah.
Right? The CFPB is trying to make things fair,
Right.
but sometimes that can create more problems than it solves.
Right. So unintended consequences.
Unintended consequences.
Okay, well, let's move on to the next point then.
Right.
The cost of compliance.
Okay.
This seems like a natural follow-up to what we've been discussing.
It really is. All these regulations.
Yeah.
Treaty, qualified mortgage, RSBA enforcement mortgage servicing rules. They all cost money to implement.
Right.
Lenders have to hire more people.
Yeah.
They have to invest in technology. They have to spend so much time on paperwork and making sure they're in compliance.
And all those costs ultimately trickle down to
The consumer.
the consumer.
Right. Higher fees for borrowers. Higher mortgage rates.
Okay. And it's not just the big banks that feel this, right?
No, it's especially tough on smaller lenders.
Really?
Yeah, they often have much smaller margins and fewer resources to deal with all this compliance stuff.
So they have to raise their rates even higher?
They might have to just to stay in business.
So less competition.
Less competition.
Fewer choices for borrowers.
Potentially higher costs.
Wow. So the regulations that are supposed to be protecting consumers
Yeah.
could actually be limiting their options
It's a paradox.
and making it more expensive to get a mortgage.
Forge. Sometimes
Yeah.
that's how it plays out.
Okay, well, that leads us to the sixth point then.
Right.
The chilling effect on innovation.
Interesting.
So the CFPB is like stifling creativity in the real estate world.
Well, that's what the study argues.
Oh.
They're saying that because the CFPB has so much authority
Right?
and because no one's really sure how they're going to enforce things,
Yeah.
lenders get really nervous
Okay.
about trying anything new.
So they just stick to the old ways of doing things,
They play it safe.
even if there might be a better way.
Yeah. It's like they're so afraid of doing something wrong
Right.
that they don't even want to try anything new.
Even if it could help borrowers.
That's a real concern.
Okay, so imagine you're a lender
Okay.
and you come up with this amazing new loan product that
Yeah.
can help so many people become homeowners.
Right.
But you're terrified that the CFPB is going to come down on you
Right.
for violating some obscure rule.
It's a chilling effect.
It's like the fear of getting punished
Yeah.
is greater than the reward of innovating.
And that's what this study is arguing,
Okay.
is that this hesitancy to innovate
Yeah.
could be holding the entire real estate industry back.
It's like a balancing act
It is.
between protecting consumers and allowing for innovation.
And keeping the market dynamic.
Yeah. Okay, so we've covered 6 of the 7 points.
6 out of 7.
What's the final argument? All right, so we've been really digging into this study on the CFPB's impact on real estate.
Yeah, it's been a fascinating discussion.
Yeah, and it's clear that, there are a lot of different perspectives here. Good intentions, potential downsides.
Right.
And it's all about trying to find the right balance.
Absolutely.
So what's the final takeaway here?
Well, the 7th point really brings everything together.
Okay.
It boils down to this.
Mm-hmm.
While the CFPB's mission is super important, right?
Protecting consumers.
Protecting consumers.
Yeah.
This study suggests that their approach might actually be creating more obstacles than solutions in the real estate market.
So it's not about saying that, consumer protection is bad.
No, not at all.
Or that we don't need regulations.
Right.
It's more about questioning whether the CFPB's methods are actually achieving what they're supposed to achieve.
That's exactly. Are they really making things better for consumers?
Right, because the study argues that instead of empowering consumers, the CFPB's actions might actually be making the whole home buying process more complex, more expensive,
more difficult,
and less accessible.
Especially for people who don't fit neatly into their boxes.
Yeah, it's like they're trying to prevent every single risk. But in doing so, they're creating a system that's so rigid that it ends up hurting the very people it's supposed to help.
It's a tough paradox.
Yeah, it really is. But, this all kind of makes me wonder about the future of real estate.
What do you mean?
Well, especially with, technology changing so rapidly.
That's a great point. I mean, the real estate industry is on the cusp of a tech revolution.
Yeah.
There are new platforms and services popping up all the time.
Right. And so how do the CFPB's regulations adapt to this new landscape?
That's the million-dollar question.
Right. How do we make sure that these regulations keep pace with innovation, but without stifling it? It's tricky.
Yeah, it really is like trying to hit a moving target.
Exactly.
We don't want to, burden these startups with all these regulations that were designed for the old way of doing things. But we also want to make sure that, these new technologies are being used responsibly.
Absolutely.
Ethically.
We've seen what can happen when things go unchecked.
Right, like the subprime mortgage crisis.
Exactly. Technology played a role in that.
Yeah. So how do we find that balance?
Well, one idea is to maybe move away from this one-size-fits-all approach to regulation and instead create a more flexible, adaptive framework.
So instead of trying to predict every possible innovation and come up with specific rules for each one,
which is impossible,
right? The CFPB can maybe focus on establishing some broad principles and guidelines
that prioritize consumer protection, fairness, transparency.
So set the guardrails.
Set the guardrails.
But allow for innovation within those boundaries.
Exactly. Give companies some room to experiment and try new things. Okay, I like that. But how do we make sure that these new technologies are actually benefiting consumers?
Well, data and transparency are key.
Okay.
We need to be collecting data, analyzing it, to see how these technologies are impacting different communities.
Right. Are they expanding access to credit?
Are they making the market more equitable?
Or are they just, perpetuating existing biases?
Exactly. We can't just assume that technology is going to solve all these problems.
Right. It's a tool.
It is a tool.
And it can be used for good or for bad.
Precisely.
We need to be really careful about monitoring its impact.
And making sure it's being used to create a more just and equitable housing market.
Couldn't have said it better myself. And, we need to make sure that consumers have a voice.
Absolutely.
In shaping these technologies, right?
It's not just about regulators and tech companies.
Right.
It's about creating a collaborative ecosystem.
Where everyone is working together.
Towards a common goal.
I love that. Well, this has been a really insightful deep dive.
It has.
I feel like I've learned a lot.
You too.
About the CFPB, their role in real estate, and all the challenges that come with trying to balance consumer protection, innovation, and fairness.
It's a complex issue.
It really is.
But it's an important one.
Absolutely. Well, thank you so much for joining us on this deep dive.
It's been my pleasure.
And to everyone listening,
yes,
this is just the beginning of the conversation.
Keep learning, keep questioning,
and keep pushing for a better world.
We'll see you next time.